The broadcast is now starting. All attendees are in listen-only mode.
Welcome to our 2019 webinar series. Our 2019 monthly webinars will include client stories, your client stories, and how those stories can help you and other clients in this year and beyond. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask all questions as you have them by typing them into the questions box. We'll answer all questions at the end of the webinar. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2019, loyal fans will receive 10 CFP CE credits, one for each month. Today's presenter is constantly monitoring the changes in annuities and hybrid insurance combos to ensure your clients are getting the most up-to-date solutions. He joined LLIS in 2008 and has over 20 years of analyzing, studying, and researching annuity solutions. Here to share his knowledge on hybrids is Jerry Skapiak.
Thank you, Claudia. Well, this is going to be my last webinar for the year, but we have plenty others that are going to be happening for you. Today we are going to talk about hybrid life insurance, and as I like to call it, having your clients' money do double duty, that they either have in existing policies or money that they may be thinking about using for long-term care insurance. So long-term care, let's go over a couple of stats for it. 52.3% of people turning 65 are going to have a need, some type of long-term care need in their lifetime. Now, the question we don't know is how long is that need going to be? Is it going to be a couple of days, a couple of weeks, a couple of months? Is it going to be several years? That's the big unknown we don't know. But we do know about a little over 52% of people who are turning 65 are going to need long-term care at some point. And as the population continues to age, that number will continue to increase. Of the people needing long-term care, 46.7% of them are men who will need long-term care at some point in their lifetime, and 57.5% of women over turning 65 will need long-term care at some point. So the reason the women are higher than men, they live longer than men, and because of that, there's a greater chance that they're going to need long-term care at some point. 10% of Americans over the age of 65 have Alzheimer's or dementia. That's the one thing a lot of people are afraid of, or they know people that have it. It's a special care that's needed to help people with that. 33% of Americans over the age 85 have Alzheimer's or dementia. As our population gets older, that number is going to continue to increase. In fact, if we look at the next stat, projected increase in the number of people with Alzheimer's or dementia between 2017 and 2030 is going to grow to 35%. What we're finding is that people who take better care of themselves are living longer, and they are actually the ones that are at the greatest risk of developing Alzheimer's or dementia in later life. 83% of care provided to older adults is delivered by friends or family members. That is a huge number. We used to have a slide up, let your daughters be daughters, don't let them be caregivers. Some people, we all understand, when they don't have the financial means, they have to rely on family members to take care of them. But a lot of your clients do have some means to where hopefully they are able to pay someone to come in and take care of them and not put that burden on their families. And in fact, if you look at that last stat, 70% of caregivers who are providing care to people, if they have full-time jobs also, that work is suffering because of it. Providing that care just takes so much time, it wears on those people. So if they're able to have someone who can go in and provide care and relieve that from family members, it can make it a better situation for everybody. So why why don't clients purchase long-term care insurance? Well, the number one reason that we hear is that it costs too much, or that premiums are not guaranteed on long-term care policies. Yes, as we saw, when you look at other forms of insurance, long-term care, the odds are higher that your clients are going to need it and use it at some point. That's why the costs are so much higher. We're also, the usage rate is very high for people who do have those policies. So that's why we're seeing the cost so high on these policies. And then two, clients, they don't want to pay for something they may never use. So if they're paying these big premiums, they want to feel like they're going to get some benefit for those premiums that they're paying. And that's really where the hybrid policies come in to play, is for these people who don't want to pay for something they may never use. So let's take a look. Who is the ideal client for long-term care? Well, or for hybrid solutions. So this ideal client is someone who wants guaranteed premiums. With any of the hybrid solutions out there, everything is guaranteed in those policies, including the premium. So when they purchase the policy, if they got to pay $4,000 a year for it, that's guaranteed for life. The insurance company can never come back and try to increase those premiums. They want a guaranteed return of some form of a benefit. So if it's a hybrid life policy, either they're going to use it for long-term care, or if they never need the policy, then it's going to pay a death benefit to the beneficiaries. If it's a hybrid annuity, if they never use it, there's going to be a cash value in that policy that will be paid to beneficiaries. They want payment options. With traditional long-term care, our only payment option is a level annual premium payment. With the hybrid options, we have several different options. You could do a level, you could do a short pay like a 10 or a 20 pay, or you could even do a single premium into them. Clients don't want to pay for something they may never use. Kind of covered that. That's one of the main reasons why someone's looking at a hybrid policy. And elimination period greater than 1 year. The states set how long an elimination period can be on a traditional long-term care policy. And the longest that's available in most states is going to be 1 year. The reason for that is if you start doing longer elimination periods, it does bring down the premium, and agents will sell those longer elimination periods to clients just to get a sale. So the states put caps on how long that elimination period can be. Now, wealthier clients want longer elimination periods because they have the means to pay for that care up front. That's where a hybrid policy comes in. Because with hybrid policies, when a client goes on claim, they use their own money first in those policies. So it's like having a longer elimination period because they're using their own money first. It's going to satisfy that. So who are ideal clients for these policies? Continuing, someone who didn't qualify for traditional long-term care may still qualify for a hybrid policy, and specifically the hybrid annuity. That policy has simplified underwriting. So a lot of times if someone hasn't qualified for traditional long-term care, they may qualify for the hybrid annuity. Now there still are some conditions with the hybrid annuity that will still prevent someone from qualifying. For example, like if they have MS or Parkinson's or HIV, those type of things still won't let them qualify for hybrid annuity. But a lot of other situations where they would be declined or have been declined for traditional long-term care, they are able to qualify for the hybrid annuity. Also, for your clients who have an existing annuity or life insurance policy that has cash value and they don't need it for the purpose they originally purchased it for anymore, we can do a 1035 exchange into the hybrid solutions. So kind of having that money do double duty then. If they had a life policy, we could do 1035 exchange to a new life policy where they still have a death benefit, but then they also have long-term care coverage. And Another big area where these hybrid solutions come into play is for clients who have enough assets where they can self-insure themselves. So by reallocating a portion of their money into a hybrid solution, we can give them a much bigger long-term care pool. I know a lot of you are wondering how big of a pool they could get. So let's look at some examples. We had a client, we took $123,000, we moved it into a hybrid policy. We gave them a $567,000 pool for long-term care. Now, if they had not moved that $123,000 and they need long-term care, after they spend $123,000 of their own money, they have to keep taking money out of their pocket and pay for that long-term care. But with a hybrid policy, like I said, they use their own money first, long elimination period. They spend their own $123,000 first, but then they got the rest of that pool of long-term care to continue to pay for those services that they need without reducing their out-of-pocket anymore. We had another client, $175,000, moved that into a product and got them unlimited benefits. So there's no maximum how much that policy will pay out. Another client, we put $100,000 into a policy, gave them a $250,000 long-term care pool. So as you can see with these policies, we can leverage money and give clients much bigger pools to help protect them when they need long-term care and help protect those assets that they've worked so hard to accumulate. So with hybrid options, we have a couple of different options available to them. We have hybrid life policies, we have joint hybrid life policies, and we have hybrid annuities. So let's take a look at hybrid life policies and what options are available. So with these policies, we can maximize the death benefit or we can maximize the long-term care benefit. There's two different types of policies, so we got options depending on what's important to the client. We have funding options. We could do a level pay. We can do a 1035 exchange from another life insurance policy. Cannot do a 1035 exchange from an annuity to a life insurance policy. But you can go life to life or life to an annuity, but an annuity can only go to another annuity. And we could do shorter pay options. We could do 10 pay or shorter with these policies. There is underwriting with them. A lot of times it's a little bit more simplified than traditional long-term care or life insurance, but they still do have to go through underwriting with these policies. And long-term care that's not used, there's a death benefit there that will pass on to beneficiaries tax-free. So here we have Robert. He's 67, lives in California. And by the way, every case we look at in here was an actual clients that we actually implemented these plans for them or went through these steps. So Robert has a life policy that had about $72,000 of cash value in it. His cost basis was $43,000, a gain of $29,000. So surrendering the policy, not a really good option for him. He'd have to pay taxes on that $29,000. And he had a need for long-term care. So when the advisor came to us and they tell us, what the client has, what their needs are, we have options for them. So with hybrid life policies, there's two types. There's what I call a traditional hybrid life and then a supercharged hybrid life. So looking at the traditional hybrid life, this policy is going to maximize the death benefit of it. So especially if you have clients, who have a need for life insurance, but it would be nice to have the capability to get long-term care benefits with it, this is a great policy for them. Long-term care benefits are 2% of the death benefit, and everything's guaranteed in these policies. So you're getting a guaranteed death benefit, your monthly long-term care benefit is guaranteed, and your long-term care pool is guaranteed. So for Robert, he has a $72,000 premium. That would be a 1035 exchange. That will buy a death benefit of $135,200. With these policies as traditional hybrid life, our long-term care pool is equal to our death benefit, and our monthly long-term care benefit is 2% of the death benefit. So in a sense, he has a $2,704 monthly long-term care benefit. Fast forward to age 80, everything's exactly the same. There's no inflation on this policy. So how does this look when claims are paid out? So when claims are paid out, they are going to be subtracted dollar for dollar from our long-term care pool and our death benefit. So when Robert goes on claim, he's going to receive the $2,704 a month or $32,448 a year. That gets subtracted dollar for dollar from that long-term care pool and the death benefit. At the end of age 80 of receiving benefits, his death benefit is down to $102,752. If he passes away at this time, that is what his beneficiaries receive. We go to year 2, same thing, same benefits are paid out for the year. His death benefit gets reduced down to $70,304. And then this will continue for a total of 50 months with this policy until the death benefit's depleted to 0. At any point when he dies, whatever the death benefit is, would be paid to the beneficiaries. So what are the pros and cons of this type of policy? Well, we're able to transfer old life policies into it. We're getting guarantees. So we're getting that guaranteed monthly long-term care benefit, that guaranteed death benefit, and we're able to provide long-term care benefits with no additional premiums to the client. So it's a zero cost out of the client's pocket to get that benefit. The cons, there's no inflation protection, and these policies really don't build any cash value. So the focus of it is to give them a death benefit and long-term care benefits. Now, the other type of hybrid life policy is this supercharged policy. And I will tell you up front, this is what we do, what most clients and advisors like. And this is what we most of the time do for your clients. So what does Robert get with this policy? Well, this policy minimizes the death benefit on the policy, and it maximizes the long-term care benefits. We also have inflation options available on this type of policy. We get choice of benefit periods, and after 5 years, on this particular one I use as an example, you get a full return of premium or an 80% return of premium. So what we're kind of seeing when we're looking at the long-term care benefits, it really looks very similar to a traditional long-term care policy, but it kind of has this life insurance wrapper around it. And with the return of premium, I always do the 80% return of premium on this policy because anybody who's really looking to purchase or move into one of these hybrid solutions shouldn't really be thinking in the future that they're going to be surrendering the policy or taking money out of it. The goal is to maximize the long-term care benefits we can get out of this policy. So by going with that 80% return of premium, that's how we're able to maximize the long-term care benefits. So going back, looking at Robert's $72,000 premium, this is going to give him a monthly long-term care benefit starting out on that first year of $3,302. His total long-term care pool is $166,700. Death benefit, notice, is small. It's only $101,376. We're minimizing that death benefit to maximize that long-term care. And our return of premiums, $57,600. What's nice with this policy is we have 3% compound inflation on it. So when we fast forward to age 80, our monthly long-term care benefits growing to $48.76. Because that's growing, our long-term care pool has grown. Our death benefit has shrunk. And the reason that has shrunk, remember, we're trying to minimize the death benefit. With life insurance, in order for a policy to qualify for as life insurance according to the IRS, there has to be a certain gap between the cash value of the policy and the death benefit. As you get older, that gap shrinks. So that's why we're seeing this death benefit decrease, because that gap shrinks over time, so that we're able to, the insurance company is able to lower that death benefit and keep that internal cost for the life insurance lower therefore being able to offer a higher monthly long-term care benefit. Let me see, I got a question here. Considering all these benefits, why would one sign up for a standalone long-term care policy? So why would someone pick a standalone long-term care policy over a hybrid policy? One, they are less expensive than hybrid policies. Hybrid policies cost more money. You're paying, the client is paying to have that guaranteed return of something. That's why someone's going to consider a traditional long-term care policy, because you're paying just for that pure cost for that insurance with those policies. And then I got another question here. What is the average duration, days, months, which people use long-term care? Typically for a male, average need for long-term care is right around 2.5 years, and a female is right around 3.5 years. So going back to our supercharged hybrid life policy, we have our benefits here at age 80. So let's take a look at how these benefits change once someone goes on claim. So we're gonna have our client go on claim, and they're gonna use the full monthly maximum. So they're gonna use $58,512 a year, and that's subtracted dollar for dollar from the long-term care pool, the death benefit, and the cash value or the return of premium in the policy. So when we look at the end of year 80, our long-term care pool is reduced down to $186,000, our death benefits down to $21,000, and there's no longer any cash value in the policy. So at this point, if the client passes away, their death benefit's going to be to their beneficiary $21,000. Fast forward year 2 of claim. If you notice, our monthly benefit went up a little bit because we got that 3% compound inflation growing. Our long-term care pool also went up. We're going to use the full amount again. We get the end, our long-term care pool is down to $133,000. Our death benefit is reduced to 0. Return of premium was 0 before we even got to the second year. But these policies have a residual death benefit, so there's always going to be a small death benefit. In this case, it's going to be $3,984. And that's what would be paid to the beneficiary whenever the client passes away. And then this is, once again, is going to continue until that long-term care pool is depleted to 0. That death benefit will just stay there in force until death of the client. So what are the pros and cons of this policy? Well, we're able to transfer, once again, that old policy and use those cash values to buy a hybrid life policy. Once again, everything's guaranteed in that policy. So we got guaranteed monthly long-term care benefit. We have a guaranteed death benefit. We have that guaranteed cash value. And we have guaranteed growth in the policy with that 3% inflation. And that is another pro to this policy, is that inflation protection. The con, all I want to come up with is that it's just the 80% return of premium. And that's just simply because that's what I always run these at, because I want to maximize the long-term care benefits for your clients. So here was a very interesting case that we had. We have Joel and Sarah here. They each have a VUL policy. Joel's, as you can see, had much more cash value than Sarah's. Joel had almost $300,000. His cost basis was $172,000. A gain of $127,000. Sarah's, as you can see, cash value was $14,000, cost basis $18,000. So she's actually in a loss position. Now, they both wanted long-term care. They didn't really want to have to take any money out of their pocket and to pay into long-term care. But as you can see, there's a great mismatch. If we used all of that cash value for Joel, he would have an enormous monthly long-term care benefit and an even bigger long-term care pool. But what we were able to do is, because he has such a high cost basis in this policy, what we had them do is, once Joel and Sarah were approved, but before we had any policies issued, we had Joel take a withdrawal out of his policy of $130,527, not to exceed his cost basis. He could take cost basis out of his policy and he doesn't have to pay any taxes. Then what we did is we transferred the remaining cash value of that policy, which was a lot of gain in that policy at that point, to the hybrid life policy. For Sarah, we transferred her existing policy, that $14,000, into her hybrid policy, and then we had them write the check for that money we took out of Joel's, that $130,000, and write that to Sarah's policy. And what they ended up with is they each had a hybrid life policy with a monthly long-term care benefit of $7,600 a month, a 4-year benefit period, and 3% compound inflation. And they didn't have to write any new checks out of their pocket to get them equal amounts of long-term care insurance. So I got another question here. If claim is never made, does the death benefit remain above premiums paid? Yes, it does, on the examples we looked at. So what did we accomplish for Joel and Sarah? Well, we provided 2 great options to cover long-term care needs. They got a guaranteed long-term care pool with inflation protection, and we were able to put sleeping dollars to work. They didn't need those life insurance policies anymore. They didn't need those death benefits, but they didn't want to pay taxes on the gains in those policies, and they also had that need for long-term care. And the clients and advisors are able to check off their long-term care concern with that solution. So here we have Dominic, who's 62, lives in Minnesota. He needs long-term care insurance, does not want to pay for something he may never use. It's something we hear all the time. I'm sure as advisors you hear it more than we hear it. But he doesn't have a lump sum to pay the premium. So everything I've kind of looked at and talked about so far has been using lump sums. But that is not the only way in which a client can get one of these hybrid policies. They can pay annual premiums into these policies. So what we did is we looked at a hybrid life policy for him. So what he wanted was a $5,000 monthly long-term care benefit. So with that, we're going back to that traditional hybrid life policy. So in order to give him a $5,000 monthly long-term care benefit, we need to look at a $250,000 death benefit. 2% of that gives us $5,000 a month. Nationwide, it would take a premium of $6,511 to get that policy. Also, the payout method on this policy is an indemnity policy. A lot of the hybrid policies are indemnity for traditional hybrid life policies. And what that basically means is once a client goes on claim and they qualify for the long-term care, the insurance company is going to continue to send them the $5,000 every month. They don't have to submit receipts. They're not reimbursement policies. Prudential, the premium's a little bit lower and is also an indemnity policy. American General is a little bit lower yet, also indemnity. State Life has a unique policy. If you notice under the long-term care benefit pool, we have the infinity symbol. That's because with this policy, we are able to get unlimited benefits with it. You can't get that on traditional long-term care policies anymore. In fact, this is the only policy I'm aware of that offers this benefit, is the State Life policy. As you can see, the premium's a little bit higher on it, also has a little bit lower death benefit, but we're still getting that same $5,000 a month, and we're getting an unlimited benefit period. Some clients, that's really important to. What we see is the wealthier clients, they want to make sure they're able to protect their assets more so than clients that maybe haven't saved as much in retirement. The wealthier clients seem to really like that unlimited benefit. So what's the pros and cons to this type of policy? Well, they don't need that single premium, and they're able to guarantee some type of return. And what that's referring to is either a death benefit or the long-term care benefits. The cons, there's no inflation offered on those policies, which we already talked about. So now let's take a look at the joint hybrid life. And this is really where I see this being used is for wealthier couples seem to like this policy a lot. And one thing with couples, they want to do everything together. I know my wife and I, we always want to do everything together. And it's the same when they're looking at long-term care. Couples want to buy the policies together and love the option of being able to get a joint policy. So what do you get when we're looking at this policy? Well, it's a second to die whole life policy. Don't get hung up on the term whole life. It's just the chassis they use for the policy. Long-term care benefits are either 2 to 3% of the death benefit. And we're getting guarantees. We're getting a guaranteed death benefit, monthly long-term care benefit, and long-term care pools could be anywhere from 33 to 100 months. Or we could get lifetime benefits on it. And we have payment options. Everybody loves payment options. We could do this as a single premium. We could do 10 or 20 pay. We could even do a level pay into it. And because it's a joint policy, it's less expensive than doing 2 individual policies. So how does this work? So we have Tim and Abby here. Tim's 59, Abby's 56. They want long-term care, and they want a monthly benefit of $4,500 a month. And they wanted shared care. They want guaranteed premiums. Once again, with traditional long-term care, you can't get those guaranteed premiums with it. And they wanted to pay with a single premium. Hybrid policies generally cost a lot less when paid with single premiums, and they illustrate a lot better when we're able to use a single premium. So in order to get them their $4,500 monthly benefit, it takes a death benefit of just about $150,000 to get them there, and it's a single premium of $69,278. And we do have a surrender value that's almost equal to the premiums paid on this policy. If we fast forward to age 80, our monthly benefit stays the same. Our death benefit stays the same. Our cash value is growing a little bit. That's always nice. That's not really a reason why we're even looking at this policy is because of the cash value. We're really looking at it for the long-term care benefits it can pay. So when we're looking at age 80, how does this look when they go on claim and the policy starts paying benefits? Well, kind of like what we've seen already. It's going to be subtracted. Any benefits paid are subtracted dollar for dollar from the death benefit and any cash value, or in this case, return of premium. So because it's a joint policy, they each can be on claim at the same time, and each of them receive the $4,500 a month. So what we use in this example, we just assume they both go on claim at the same time, so the policy is actually going to pay out $9,000 a month to them. And that's subtracted, once again, dollar for dollar. So at the end of that first year of paying claims, death benefits reduced to almost $42,000, and there's no cash value left in the policy, which is perfectly fine. They're using their own money first. They're receiving a nice monthly long-term care benefit. Second year of claim, same amounts are paid out. At this point, there's no death benefit left in the policy. There's no cash value left in it, but the policy will continue to pay that $9,000 a month. Let's fast forward to age 90, 11 years of paying claims. It's still paying the same amount every year, but in total, it would have paid almost $1.2 million out to age 90. This policy has no limits on how much it will pay out. For your clients who want to make sure they're protecting that tail risk for long-term care, maybe they can afford 2-3 years of paying long-term care benefits out of their assets. But when you start getting over that, it can start jeopardizing the plan, especially for the surviving spouse. This policy makes great sense to protect against that risk for your clients. So what are the pros and cons of this policy? Well, we're able to pay this with a single premium. Everything's guaranteed in the policy again. We're able to get unlimited benefits, and it has shared care on it. This policy, as illustrated, has no inflation protection. They actually have just come out with a new version of this policy, and a lot of states do offer inflation on it now. So our next time we present this product, we will have different slides, and we will be showing how it works with inflation protection. So what do we accomplish for them? Well, simply by reallocating existing dollars, we're able to have it do double duty. They were going to more than likely self-fund a long-term care event, but by reallocating some of those dollars, the cash value is still there if they need it for some reason, but we're able to give them an unlimited long-term care pool by reallocating it. They got the guaranteed long-term care pool that can't be outlived, and guaranteed no more premiums. These policies, everything's guaranteed. They pay that single premium. Insurance company cannot come back later on and say, you know what, we're getting more claims or we didn't price it quite right. They can't come back and ask for additional premiums like they have been able to do on the older long-term care policies. And again, any death benefit that's going to be paid is going to be paid tax-free, and long-term care benefits are also paid tax-free on any hybrid policy. And clients and advisors are able to check off their long-term care concerns. So now let's take a look at the hybrid annuity. So with the hybrid annuity, it's just like any other type of long-term care policy. The IRS actually sets like what constitutes qualifying or what qualifies the policy for providing long-term care on a tax-free basis. And what the IRS says is that the client has to not be able to do 2 of the 6 activities of daily living or have a severe cognitive impairment. That is all set by the IRS. Any long-term care policy that's offered today follows these guidelines. Any long-term care benefits are paid tax-free. The IRS sets the guidelines. As long as those are met, they say any benefits paid out are paid tax-free. And currently with the hybrid annuity, it's only available on single premium non-qualified assets, and it is only available as a fixed annuity. So we cannot do it as a variable annuity, and we can easily cover a spouse or partner with one policy. So annuity has some special things that happen. So as we said, it's a fixed deferred annuity. Long-term care benefit is a multiple of the single premium. So very simply, if it's one individual applying for the annuity, if you take whatever that premium is, divide it by 24, that will tell you what your monthly long-term care benefit is. Or if it's a couple, divide that single premium by 30. We can do 1035 exchanges from an existing life insurance policy or an existing annuity into this hybrid annuity. And long-term care benefits not used, the value of the annuity is going to pass on to the beneficiaries as a death benefit to them. Or if the clients change their mind, it's still an annuity. They can withdraw the money out of it. They can annuitize it. They can do whatever they want with it. So what do you get with these hybrid annuities? You're getting that fixed deferred annuity. You're getting guaranteed monthly long-term care benefits. Long-term care pool is going to be somewhere anywhere from 60 to 138 months. You have options with it. And we can add a spouse to it. So even if one spouse has, let's say, a life insurance policy in their name, we can do a 1035 exchange to the hybrid annuity and add on the other spouse, and they call it another insured. We're able to add them on so they both are able to have coverage under the hybrid annuity. So how does this work? Here we have Carl, and this is an actual case. He was 62, lived here in Florida. He was declined for traditional long-term care insurance. Why was he declined? Well, his bill was $572.25. That's not really going to cause a decline. He had gastric bypass surgery back in 2015, so he used to weigh 325 pounds. That's really not going to do it. Some time went past. He's maintained that weight of 225, so that's not it. He's on 2 bipolar medications. This can contribute a little bit to it if his medication's been stable for a year, so no changes in medication or dosage amount. Generally, you can qualify for long-term care. It's not an issue. Oh, here it is. He eats edibles once a week. And if you're not sure what edibles are, that's marijuana. With long-term care insurance, it used to be that any use of marijuana, any form, would be an automatic decline. There is one company now that does allow the use of marijuana on a limited basis for recreational use. If marijuana is being used for medical reasons, it will still be an automatic decline, mostly because of the underlying reason why they would be using marijuana. But unfortunately for Carl, when he applied, that was not the case. So he was declined for traditional long-term care. But fortunate for Carl is the hybrid annuity didn't really care that any of this had happened to him. They were going to approve him for coverage. So what do we have with the hybrid annuity? Well, we have 3 options. So Carl was going to put in $100,000 into the annuity. And then you have options. You can add a rider on to the annuity that will extend the long-term care benefits either 36, 72, or 108 months. So let's take a look at Carl here. So he has $100,000, and at the end of year 1, we see our 3 options here. So if we look at option 1, his cash value has grown to $101,139. Option 2, cash value actually decreased a little bit, and even on with option 3, the cash value decreased. So why is that? So let's go down. If we go down into the box in the center here, we have our long-term care accumulated value. This is nothing more than the original premium in the policy growing at a slightly higher interest rate. There's this long-term care extension. That's that 36 months, 72 months, 108 months. So as you see, we have bigger and bigger and bigger long-term care pools. And when we look at our total long-term care pools, option 1, we have a total of 257. Option 3, it's 548. There is an internal cost for the long-term care on this policy. It's because of that internal cost, that's why we see the cash values decrease on the policies. And below we have our monthly long-term care benefits for option 1's $42.84, and it decreases down to $41.54 for option 3. Depends on what the goals of the clients are. Do they want to maximize that long-term care benefit, or do they want to make sure they have coverage for a long period of time? So what I want to do is focus on option 1. Carl single. Normally that's what we recommend, is just option 1, because remember that $100,000 is going to be used over 24 months, and then he has another 36 months. So he basically has 5 years worth of benefits on the policy. So what does this look like if we go out to age 80? As you can see, our cash value is growing, our long-term care accumulated value is growing, our extension stays the same, and our benefits are all right here. So we see what Carl has at age 80. So how does this look when Carl goes on claim? So he's going to use the full monthly long-term care benefit. Remember, it's a hybrid policy. We use our own money first with these policies. So any benefits paid are going to be subtracted dollar for dollar from the cash value and that long-term care accumulated value, because that's just his money growing at a little bit higher interest rate. And also it's going to be subtracted dollar for dollar from the long-term care pool. So at the end of year 1, our cash values decreased to $39,138. Our long-term care accumulated values at $80,635. Our extension stayed the same. our long-term care pool decreased to $322,530. We look at the second year of claims. So we're going to take the rest of the cash value from the policy he's going to use up. He's going to use almost the rest of his long-term care accumulation value to where he only has $7 left in it. And then his long-term care pool has decreased once again by the $80,628. Now, anytime someone's buying one of these policies, this is why you're ultimately buying this policy, because here the policy has, you've used all your money first. You got $7 left of, I guess, technically of your own money in long-term care accumulated value, and we're getting ready to have the insurance company take money out of their pocket and continue to pay long-term care claims. So when we look at year 3, we're going to take the last $7 of our money, and now we're going to start taking money from the insurance company. In fact, we're going to take $80,621, and then we see what we have at the end of that third year. Our long-term care extension and long-term care pool are the same, and they're each $161,274. That's great. And we take a look at year 4, we subtract again the $52,260, and we got 1 year left of benefits left. So this policy works really good. It's a way for clients who have a lump sum that they can put in, and we can increase that long-term care pool about 2.5 times what that premium was. So what's the pros and cons to this policy? Well, he didn't qualify for traditional long-term care policy, but he was able to qualify for this hybrid life policy, and everything's guaranteed. Cons, there's no inflation protection as illustrated. They do offer it on that rider. Makes the policy a lot more complicated to go over. Try to keep it simple when we're doing webinars. But if anybody's interested, I'd be happy to talk to you one-on-one and explain how the inflation works on this policy. So what did we accomplish here? We've found a long-term care solution he qualified for. We relieved the stress of being uninsurable. No one likes to be told they are uninsurable. So we relieved that stress from him. We were able to guarantee no premiums or no more premiums and a death benefit if long-term care benefits are not used. And the client and advisor were able to check off their long-term care concern, which they tried to do earlier, but he couldn't qualify for, but they were able to do it now. So we talked a lot of different things with long-term care hybrid options here. So what we've done is we've put together kind of like a little cheat sheet that you can use with clients. And if you kind of look at it, if we just look here, they have an existing annuity. Their only option they have available to them is to look at a hybrid annuity. If they have existing life insurance, all options are available to them. Also, if they're going to kind of pay with a single premium, all options are available to them. If they want to be able to pay with annual premiums, we only have that traditional hybrid life policy available and a traditional long-term care policy. If they have health issues, really the only option is going to be the hybrid annuity. If they want to have a spouse or shared care, we can do that on a traditional hybrid life policy. We looked at that example. Or we can do it with an annuity or traditional long-term care. If you want joint coverage, but only one owns an annuity or life policy, our only option is going to be the annuity for them. Inflation protection. Our only options are really going to be that supercharged hybrid life and a traditional long-term care policy. And if they want guaranteed premiums, it's going to be all options and not the traditional long-term care. So if you kind of know what your client wants, you can kind of go through this, check off what it is they want, and it's going to kind of tell you what options are available to them. So today we've covered the hybrid options that were available. We looked at hybrid life, we looked at traditional hybrid life, the supercharged hybrid life. We looked at a joint hybrid life, and we also took a look at the hybrid annuity. So what do we got coming up here at LLIS? Well, we're going to be at the XYPN Live Conference. I will be there and Jill will be there. Jill and I will also be at the NAFA conference coming up in October. And I know for sure I'll be at the ACP conference. I'm not sure if Jill or anybody else will be going with me to that conference. So what are the 10 things that make us different? Well, one, we do these monthly webinars for you. Coming up in September, it's Life Insurance Awareness Month. So we're going to look at what is the best choice for your clients. We're not your competition. We don't manage money. For those of you that have worked with us, you know the only thing we talk to your clients about is what you are recommending that they get. You are our only client as the fee-only financial advisor. We view your client as your client. You are our client. We save advisors time and your clients money. What it's really coming down to is we do a lot of pre-underwriting for your clients. We're able to look at different options for your clients before we even apply for them. In fact, this plays into an email I answered right before I started this webinar. We had a client, they just had a policy put in place in July. The client was approved at a standard plus underwriting class for term insurance, and they're going out getting quotes from someone who gathered no health information from them, quoting them preferred plus. This was my client I had worked with. I had to go and check with other insurance companies to see what underwriting class to quote this individual before I ever sent the quotes, because one thing we never want to do is mislead your clients by quoting them a lower premium than what they'll be approved at, which is what this other agent's doing to this client. And I spell it out to them. These are the facts of why you were approved where you were, and it was the best option for them at that time. If you go to our website at llis.com, we have an advisor section. You go in there, we have advisor tools, a lot of useful information for you. We are proud sponsors of all these different organizations for fee-only financial advisors. We have specialists in life, disability, long-term care, annuities, and hybrids. I'm your annuity and hybrid specialist. I also do a lot of the term insurance for the office. We also manage your clients' policies both now and in the future. We have a designated policyholder service team here that's here to handle all in-force questions that your clients may have. We're also going to send your clients advanced premium emails, and what that basically means, about 30 days before premiums due, your clients are going to receive an email from us letting them know, be on the lookout for your premium notice, that they're going to be receiving it. It's amazing how many times clients move and never notify us or the insurance company that they moved, and they may miss that premium notice and their policy may lapse. We also keep track of their term conversion options. A lot of times it's not beneficial, but there are those times where clients' health has taken a turn for the worse during that time they've had that term policy, and it allows them a way to continue the coverage to protect their family. And if you haven't had a chance yet to meet Alice, that is our online portal where you're able to go in and see all of your clients and see everything that we've done for them. You can view any quotes, anything that's been uploaded for your clients right there. Advisors have loved it. We've heard nothing but positive feedback on that. So I'm going to go to questions. I've had some other questions come in. The traditional policies that had unlimited benefits are no longer offered because the morbidity assumptions were so wrong. Do you think the joint unlimited policy carrier is making the same mistake? Do you believe this policy will pay 20 years from now? Yes, I do. So one of the reasons it's been a number of years since unlimited benefits have been offered on traditional long-term care. And that is just because those policies were priced so greatly inaccurately based on what transpired and what happened in real life. And it's also, when you have unlimited benefits, it's an unknown risk. And it's simply, with traditional long-term care, the carriers don't want to take on that risk. When we're looking at like the life insurance policies that have those policies, they're underwritten a little bit differently, and they feel comfortable that they can absorb any risk with that. And also, the company that offers that, they were the first company to offer hybrid policies. They were doing it long before the Pension Act of 2006 made them even possible with how they are today. Can you use IRA or money to get the hybrid annuity? No, it has to be non-qualified money only to get the hybrid annuity. On hybrid annuity, if a client only has qualified funds, can they still buy, and would long-term care benefits still be tax-free? Consider qualified distribution. Nope. Once again, you cannot use qualified funds on that annuity. I wish you could. It would be great, but the IRS says no to that. Is there an optimal age range to consider these hybrid long-term care options? Well, with long-term care in general, the time when long-term care starts becoming a topic of discussion is when a client is saving for retirement. You can look at the plan with the client and you say, if you keep doing what you're doing, you are going to be fine in retirement. At that point, the focus now starts switching. How do I protect those assets they have from being spent down too quickly? That's the point where the discussion of long-term care typically comes in, and the average is around age 55 when that starts happening with clients. And I got one more question. Isn't there an inflation adjustment on the hybrid annuity? Yes, there is. And I said I would be happy to talk to anybody offline about that, because it's a little bit more complicated and it can be kind of confusing when I try to present this in a webinar, because it's a little bit different and doesn't work as most people, me including, think it should work. So I don't see any other questions. Thank you, everybody, for joining in today. And you have my email there. If you have any other questions, feel free to email me or give me a call at the office. Thank you.